Hey friends, Ryan Zomorodi here, co-founder of Real Estate Skills, and welcome to Real Estate for Beginners. Whether you want to buy your first rental property, fix and flip a house, or just finally understand how real estate actually works, this video is where it starts. And here's the truth, if you learn the right skills up front, you don't have to wait years to make money in real estate. You can start seeing real results much sooner than you think, even if you've never bought a house before. In this video, I'm going to break down the essential principles that every successful investor knows. No fluff, no hype. Just clear, actionable steps that you can use to move forward in this business with confidence. I'm also going to share the exact things that I wish someone told me before I got started so that you don't waste time, money, or opportunities. These are the same principles that I've used to build a real estate portfolio worth over $10 million and pays me multiple six figures of income every single year. So if you're serious about making real estate a path to wealth, hit that subscribe button and drop a comment with any questions you've got. I read them all and I answer each one of them. And as a bonus, we created a real estate investing 101 ultimate guide, which you can get at realestateskills.com/101. The link is in the description. So let's jump in and get you one step closer to your first deal. What is real estate really? Before we talk about buying and selling properties, let's make sure we're speaking the same language. The world of real estate has its own lingo that you'll need to get familiar with so that you can speak the language of real estate. Real estate simply refers to property, specifically land and anything attached to it like houses, buildings, and improvements. For beginners, we focus mostly on residential real estate, or in other words, homes where people live. Now, within residential real estate, there are a few key types. First, there's single-family homes, one standalone property meant for one household. This is abbreviated as SFH for single family home or SFR for single family rental. Single family homes are detached structures, meaning they don't share walls with other houses. There are also duplexes, which means there are two residential housing units on one property. Duplexes are typically one building with two separate units, or they can be two detached homes on the same parcel of land. So when you invest in a duplex, you're essentially buying one property, but collecting two streams of income since you have two units, two leases, and two tenants paying you rent. Then there are triplexes and fourplexes. It's the same idea, just with 3 or 4 units. When I bought my first triplex, I knew that one unit could pay my mortgage, the other unit could cover my property expenses, and then the third unit's rent would be my profit. Then there are townhomes, condos, and row homes. These are all single occupancy residential units, but are usually part of a larger complex, often with shared walls or shared amenities like gyms, pools, or playgrounds. There's usually an organization like an HOA or a condo owners association that manages each of these communities, so there may be some restrictions for investors as well as additional monthly fees charged to the owners. So, what is the best type of real estate to invest in? I own single-family properties, duplexes, and triplexes. I also co-own commercial buildings and multifamily apartment complexes, but it didn't start like that and it didn't happen overnight. I started small just like everybody else does. At Real Estate Skills, we often emphasize single-family homes for beginners because they're simpler to finance, manage, and understand. My first rental property was a single-family home. Next, I want to talk about mortgages and how real estate investors get the money to buy properties. So let's say you find a property that you want to buy. It's listed for sale at $200,000. Most people don't just have $200,000 of cash sitting in the bank, and that's where a mortgage comes in. So what is a mortgage? A mortgage is simply a loan from a bank or lender that helps you finance a real estate purchase. Let's break it down with an example. So let's say the purchase price is $200,000 and the down payment, let's say it's a 10% down payment, that would equal $20,000. So that would mean your mortgage amount is $180,000. So this means the bank lends you the $180,000 and you commit to paying it back typically over 15 to 30 years with interest. Interest is the bank's profit for lending you the money. Of course, lenders are not just going to hand you free money without charging anything for it. Interest, along with other loan fees, is how banks and lenders make their money. The lower the interest rate on your mortgage, the better it is for you because you'll be paying significantly less to borrow that money. And residential real estate investors get some of the lowest interest rates available in lending. Unlike consumer debt, such as high interest credit cards, which you should avoid at all costs, you should think of real estate loans as good debt because your tenant pays off the debt for you and builds your equity position in the property all at the same time. Speaking of equity, let's talk about what equity really means in real estate and why it matters so much. Here's where real estate investing gets very exciting. Let's say the property that you bought for $200,000 increases in value to $250,000. That $50,000 difference, that's called equity, and it's one of the most powerful wealth building tools in real estate. Simply put, equity equals the property value minus what you owe on it. In our case, the home value is now $250,000, yet the remaining mortgage is $180,000. That means that your equity in the property is now $70,000. This is the value of your ownership stake in the property, and over time, as your property appreciates and your mortgage balance goes down, your equity increases. So even though you only put 10% or $20,000 down, you get to keep 100% of the appreciation of your property. Your $20,000 investment just turned into $70,000, and the bank doesn't get to share in any of that upside. You get to keep all of the equity. This is how many real estate investors get rich, because they buy and hold real estate, then the real estate market appreciates and their net worth increases rapidly. When you have lots of equity, you have lots of options. You can either sell the property for a big gain and cash out, or you can refinance the property and receive a lump sum of tax-free cash while continuing to hold the property. So let's talk about cash flow, a term that every real estate investor loves. If you decide not to live in the property that you buy and instead rent it out, also known as leasing your property, here's what could happen. Let's say your monthly mortgage payment is $1,000 per month. Then your monthly rent that you collect is $1,400 a month. That would mean your cash flow is $400 per month. So that $400 left over after paying your expenses is called your net cash flow. This is money in your pocket each and every month. Cash flow is amazing because it helps you build wealth passively. And when you multiply that across several properties, you start to experience what we call financial freedom through real estate. Because let's be honest, one rental property won't make you rich. You should be thinking about acquiring multiple properties and building a portfolio that will actually make a difference for you and your family so that you never have to worry about money again. And to help you do that, we put together our brand new Real Estate Investing 101 Ultimate Guide. So if you haven't already grabbed your copy, you can get it at realestateskills.com/101. The link is in the description. So here's another term that you need to get familiar with, which is PITI. What is it and why should you care? Most mortgage payments aren't just principal and interest. They usually include what's known as PITI. So the P stands for principal. This is the part of your mortgage payment that pays down the loan and actually increases your equity. I stands for interest, which is the bank's profit or the cost to borrow that money. T stands for taxes, which is property taxes. These are collected by the lender every month, then paid to the county once they're actually due. The I stands for insurance or homeowner's insurance. Insurance protects your property from the costs associated with things like flooding or damages or fires, and it also includes general liability insurance. Not only does insurance give you peace of mind, lenders will not give you a loan without home insurance. Lenders often bundle these four expenses into one monthly payment so that they're sure the home is protected and the taxes are paid on time. I actually prefer paying them all at once every month because it makes managing my income and expenses so much easier and more predictable. So let's say that your monthly payment is $1,200 a month. That might break down like this: $800 towards principal and interest, $250 for property taxes, and then $150 for insurance. All of this is important because when you're analyzing deals, you need to know your true monthly costs so that you can accurately calculate your cash flow. Simply put, cash flow equals income minus expenses. In addition to making sure your real estate produces cash flow, here's a timeless investing principle that will help you make money every time that you buy properties. This rule is simply buy low, sell high. This is the bread and butter of real estate investing. It sounds simple and obvious, but it is so powerful. You should aim to buy below market value every time you buy a piece of real estate. Savvy investors know that money is made when you buy. Let's go back to our earlier example. The property was bought for $200,000. Then let's say we sold it for $250,000. That means our gross profit before expenses is $50,000. But hold on and don't miss this. When you sell, you'll likely pay realtor fees, which typically amount to around 6% of the sales price. You'll also pay closing costs, which are usually around 1 to 2% of the final sales price. You also might pay capital gains taxes if you cash out and if you don't do a 1031 exchange, which is a smart move if your deal qualifies for one. Always factor in all of the exit costs to determine your true net profit when you plan to sell a property. Smart investors run these numbers before they buy so that they don't get surprised later. If you want my tried and true deal profit calculator, just comment below and I'll give you my deal calculator absolutely for free so that you can run your numbers accurately and analyze your profit down to the dollar. So what should you focus on as a real estate beginner? Here's what I'd recommend that you focus on first as someone new to real estate. First off, get educated. Learn your local market by talking to real estate brokers, browsing Zillow and Redfin, and attending real estate networking events. Get familiar with what homes are selling for and renting for in your market. Talk to different lenders and understand your financing options. From FHA loans to conventional loans to private money lenders, you want to at least know the basics. Focus on acquiring the right deals so that you can build equity and create positive cash flow. Don't buy real estate based on emotions. Make your buying decisions based on the numbers. Practice analyzing deals. You want to run numbers on at least a few dozen potential deals before you make your first real estate investment, or at least until you feel confident in your financial analysis. Use real property listings and run the numbers as if you were going to buy them. And lastly, find mentors and a community. Whether it's YouTube, books, or courses, learning from others will shorten your learning curve and make your life a whole lot easier while making your bank account a whole lot prettier. And who doesn't want a pretty bank account? So there you have it, your beginner's guide to real estate investing. We covered what real estate is, the different property types, mortgages, equity, cash flow, and how to buy low and sell high. These are the fundamentals of real estate. And trust me, mastering these concepts can completely change your financial future, just like it has for thousands of people who have joined the Real Estate Skills family. And if you haven't already, go download our free real estate investing ultimate guide, which you can find at realestateskills.com/101. We cover these fundamentals as well as how to get started wholesaling and flipping properties to generate the capital to start seriously buying rental properties and generating cash flow. Again, that's realestateskills.com/101, and I'll leave a link in the description. If you found this valuable, make sure to like, subscribe, and drop a comment below. Let me know what topic you want me to dive into next, and if you're ready to take your skills to the next level, check out our free training at realestateskills.com. The link is also in the description of this video. Thanks for watching, and remember, success in real estate is built on skills. Keep learning, stay focused, and take action, because this business rewards those who do.